You believe that your retirement savings are protected, that the financial system exists to serve savers and investors, that when crisis strikes, the institutions will prioritize the people who trusted them with their wealth. But in September of 2008, when the global financial system teetered on collapse, when decades of reckless leverage and fraudulent lending finally produced consequences, the Federal Reserve and United States Treasury made a choice that revealed the system's true priorities, and that choice was to create trillions of dollars from nothing to bail out the banks and financial institutions that had caused the crisis, while simultaneously destroying the retirement income of millions of Americans who had saved responsibly for decades. And this wasn't an unfortunate side effect of necessary emergency measures. This was the deliberate sacrifice of savers to preserve institutions and the mechanism through which this happened, through which wealth was transferred from people who had done everything right to institutions that had gambled recklessly and lost. This mechanism is still active today. It's still transferring wealth. It's still prioritizing institutional survival over individual security, and understanding exactly how it operated in 2008 is essential, because the same playbook will be used again, is being prepared for use right now, and the people who understand this early are the people who still have time to position themselves differently. Let me take you back to understand what actually happened in September and October of 2008, because the official story you've been told is incomplete, is carefully constructed to obscure the wealth transfer that occurred, and the story starts with banks and investment firms that had spent years creating and selling mortgage-backed securities, complex financial instruments built on home loans that were increasingly given to borrowers who couldn't afford them. And these institutions didn't just lend recklessly, they leveraged recklessly, borrowing $30 or $40 for every dollar of capital they actually held, which meant that even small losses could wipe out their entire capital base. And when housing prices stopped rising, when mortgages started defaulting, when the securities built on those mortgages lost value, these institutions faced insolvency, faced the prospect of bankruptcy, of shareholders losing everything, of executives losing their positions and their bonuses. And in a market system, in a system where risk is supposed to be rewarded or punished based on outcomes, these institutions should have failed. Their shareholders should have been wiped out, their bondholders should have taken losses, and their executives should have faced the consequences of the bets they made. But that's not what happened, because these institutions were deemed too big to fail, which means too important to the financial system to be allowed to go through normal bankruptcy, and so the government stepped in, and the Federal Reserve stepped in, and together they created mechanisms to save these institutions. And the primary mechanism was money creation, specifically the Federal Reserve creating trillions of dollars through programs with technical names like quantitative easing and emergency lending facilities, and this newly created money was used to purchase toxic assets from banks at prices far above what those assets were worth in the market, which meant the banks were bailed out, their losses were covered, their capital bases were restored, and their executives mostly kept their jobs and eventually their bonuses, while the cost of this bailout, the real economic cost, was transferred to a different group of people entirely, and that group was savers and retirees who had accumulated wealth in bonds and savings accounts and retirement plans. Here's the mechanism that made this transfer possible, and understanding this mechanism is absolutely critical because it's still operating, it's still transferring wealth right now, and the mechanism works through interest rates, because when the Federal Reserve creates trillions of dollars to bail out banks, when they flood the financial system with newly created money, one of the primary tools they use is dropping interest rates to near zero and holding them there for years. And in 2008, the Federal Reserve dropped the federal funds rate from over 5% to near zero within months, and they kept it near zero for 7 years until late 2015. And if you were a retiree in 2008, if you had spent decades saving in bonds and certificates of deposit and money market accounts, if your retirement plan was based on earning 4 or 5% interest on your savings and living on that income while preserving your principal, then what happened to you was catastrophic, because your income disappeared, it simply vanished, and you faced a terrible choice. That choice was either accept a drastically reduced standard of living or take risks you never intended to take, and millions of retirees chose risk. They bought stocks at prices that had been inflated by the very policies that destroyed their bond income. They reached for yield in riskier bonds, in dividend stocks, in assets They didn't fully understand because they had no alternative if they wanted to maintain any income at all, and many of these people lost principal during subsequent market corrections, lost not just income but the capital base they thought was safe, and this outcome wasn't accidental, wasn't an unfortunate side effect of complex policy. This was explicitly acknowledged by Federal Reserve officials who stated publicly that one of their goals with zero interest rate policy was to force savers out of safe assets and into riskier investments, because they believed this would stimulate economic growth by pushing money into stocks and corporate bonds. And think about what this means. Think about what it reveals about the system's priorities. Because the central bank deliberately made safe saving unprofitable, deliberately destroyed the income that retirees depended on, deliberately pushed people into risk they might not have wanted or understood, all to achieve macroeconomic goals that primarily benefited financial institutions and asset owners. Now here's where the crime becomes undeniable, where you see the full scope of the wealth transfer. Because while savers were earning 0% on their deposits and bonds, while retirees watched their income vanish, the banks that had been bailed out, the institutions that had caused the crisis through reckless lending and leverage, those banks could borrow from the Federal Reserve at 0% and lend at higher rates, could purchase government bonds yielding 2 or 3%, with money borrowed at zero, could rebuild their profits and their balance sheets using the very low interest rates that were destroying savers. And this transfer was massive. It was documented. It showed up in Federal Reserve data, showing that the financial sector's share of corporate profits grew dramatically after 2008, while wage earners' share stagnated. And it showed up in wealth distribution data, showing that the top 10% of households captured virtually all the wealth gains from the recovery, while the bottom 50% saw their wealth decline or stagnate. And this wasn't random. This was the predictable outcome of policies that created trillions of dollars and channeled that money to financial institutions first, where it inflated asset prices before it ever reached the broader economy. And the people who benefited were people who already owned assets, particularly stocks and real estate, while the people who lost were people who held their wealth in currency and bonds, which is exactly how retirees are typically positioned. If you've been following this documentary series, if you watched the episode on 1933 when gold was confiscated, if you watched the episode on 1971 when gold backing was removed, you're starting to see how these crimes connect across decades, how each crisis produces the same pattern. Institutions that fail get saved, savers who trusted the system get sacrificed, wealth gets transferred from individuals to institutions through mechanisms that are presented as necessary emergency measures. And the people who follow this series episode by episode, who subscribe and turn on all notifications, who watch each historical crime as it gets documented, they're developing something most people never acquire, which is the ability to see through official narratives to the underlying mechanisms of transfer, to recognize when they're being told that sacrificing their interests serves the greater good, and to understand that the greater good almost always means institutional preservation at individual expense. Once you see the system, you can't unsee it. You can't go back to believing that the financial system protects savers, when the documented evidence from 2008 shows the opposite, shows that when push comes to shove, when institutions face failure, the response is always the same. Create money, bail out institutions, transfer costs to savers through inflation and destroyed income, and present this as responsible crisis management rather than what it actually is, which is wealth confiscation dressed up in technical language and justified by emergency. And this pattern isn't historical curiosity, it's active blueprint, because the mechanisms used in 2008 are still in place, the legal frameworks still exist, the institutional incentives haven't changed, and the next crisis, whenever it comes, will produce the same playbook with the same outcomes, unless people understand what's happening early enough to protect themselves. Now let me show you the specific numbers that prove this transfer happened. That document exactly how much wealth moved from savers to institutions, because in the 7 years from 2008 to 2015, the Federal Reserve's balance sheet expanded from roughly $900 billion to $4.5 trillion, which means they created roughly $3.6 trillion through quantitative easing and other programs, and this money creation had predictable effects. It inflated stock prices, which rose roughly 250% from their 2009 lows to 2015. It inflated bond prices by suppressing yields. It inflated real estate prices in many markets, and all of these inflations benefited people who already owned these assets, but it destroyed income for people who had saved in bonds and bank deposits because someone who retired in 2008 with $500,000, expecting to earn 5% interest, expecting $25,000 per year in income, watched that income drop to near zero and stay there for 7 years, and replacing that income required either drastically cutting living standards or taking risks that many people lost money on. And here's what makes this particularly cruel, what reveals the true nature of the crime, because the people who lost income and purchasing power weren't the people who caused the crisis. They weren't the ones who made reckless loans or leveraged 30-to-1 or created fraudulent securities. They were the people who had saved carefully, who had avoided excessive risk, who had done exactly what conventional financial advice told them to do, and they were punished for this prudence. Their caution was turned against them, their trust in the system was exploited, and the institutions that had failed, that should have been allowed to fail, were preserved at their expense, and the executives who ran those institutions, who made the decisions that caused the crisis, most of them kept their positions, many of them received bonuses within a year or two of the bailouts, and none of them faced prosecution despite clear evidence of fraud and misrepresentation throughout the mortgage securitization process. Think about what this teaches you about how the system actually operates, about whose interests it serves, about what happens when institutions face consequences for their decisions. Because the lesson from 2008 is clear. Institutions are protected, individuals are expendable, wealth can be transferred legally through monetary policy, and the people who understand this, who see it clearly, who position themselves accordingly, those are the people who survive financial crises. With their wealth intact, while people who trust the system, who believe their savings are protected, who follow conventional advice about bonds and diversification and long-term thinking, those people watch their purchasing power erode, their income vanish, their security disappear, and they're told this was necessary, this was unavoidable, this was the price of preventing complete collapse. Now let me connect this to the present moment, because everything that happened in 2008 is still relevant. The mechanisms haven't been dismantled, the incentives haven't changed. The legal frameworks that allowed trillions in money creation still exist, and current conditions suggest these mechanisms will be activated again soon, because federal debt has grown from 10 trillion in 2008 to over 35 trillion today, because the Federal Reserve's balance sheet, which they tried to reduce after the crisis, is still roughly 7 trillion, more than 7 times what it was before 2008, because asset prices remain elevated relative to historical norms, supported more by monetary policy than by economic fundamentals, and because the system remains fragile, dependent on confidence, on continued money creation, on willingness to sacrifice savers whenever institutions need support. And here's what makes the next crisis potentially worse than 2008, because in 2008, interest rates were over 5% before they were cut to zero, which meant retirees at least started with some income before it was destroyed. But current interest rates, after being raised temporarily, are likely to be cut again during the next crisis, and the Federal Reserve has less room to cut, less room to maneuver, and the amount of debt in the system is so much larger that the money creation required to prevent defaults will be larger than anything we've seen before, and the inflation that results, the destruction of purchasing power, the transfer of wealth from savers to institutions and from currency holders to asset owners, this will happen faster and more dramatically than it did after 2008. And this is why following this documentary series matters, why subscribing and watching each episode as it releases is fundamentally different from seeing random financial videos, because we're building a framework chronologically that shows you how each crisis builds on previous crises, how the crime of 1933 enabled the crime of 1971, which enabled the crime of 2008, which is enabling whatever comes next, and people who follow this series, sequentially, who turn on all notifications, who watch each new historical crime as it gets examined. They're developing pattern recognition that lets them see current policy announcements and understand them not through official justifications, but through historical precedent. And this understanding is what separates people who see their wealth destroyed from people who positioned themselves to survive currency debasement and institutional prioritization. So here's what needs to happen. And I'm being absolutely direct because incomplete understanding is dangerous. Subscribe to this channel right now, turn on all notifications, because the next video in this series examines what's being built right now, what mechanisms are being put in place that will make the next crisis different from 2008, how central bank digital currencies and programmable money will give institutions control that makes zero interest rates seem like gentle policy. And once you see how each historical crime built the foundation for greater control, how the pattern accelerates rather than moderates, how your options narrow with each crisis. Unless you understand what's happening early, you'll recognize why these videos aren't entertainment. They're education that could determine whether you preserve wealth through the next crisis or watch it vanish while you're told the sacrifice was necessary. But subscription alone doesn't complete your understanding, because what we're building here is a community investigation into how power operates through monetary systems, how wealth gets transferred legally from those who earn it to those who control money creation. And that investigation doesn't happen through passive viewing. It happens through active engagement, through examining evidence together, through testing analysis against each other's experience, through allowing serious disagreement to strengthen understanding. And this is why the comments aren't just feedback. They're where the investigation continues, where the video's claims get examined, where people share knowledge and challenge assumptions. So the video doesn't end here. It continues in the comments, and here's what I want you to think through. If the Federal Reserve could create trillions of dollars in 2008 to bail out banks while simultaneously destroying retirement income for millions of savers, if this transfer was deliberate policy rather than unfortunate accident, if the institutions that failed were saved while the people who trusted the system lost income and purchasing power, then what does this tell you? About who the financial system actually serves, about what happens during the next crisis, about whether your retirement savings will be protected or sacrificed, and more practically, what does it mean to save responsibly in a system that demonstrates repeatedly it will destroy savers to preserve institutions? And how do you position wealth when the currency itself becomes the mechanism of transfer? When monetary policy is the weapon used against savers, when understanding this early is the only protection available because the system won't protect you. Write your reasoning carefully. Read what others have written. Respond with evidence, not emotion, because this community has become a place where serious people examine difficult questions without easy answers, where disagreement strengthens analysis, where the goal is understanding, not winning, and your perspective matters. Your experience contributes. Your willingness to engage rigorously makes this valuable, and this dialogue is part of the series itself, part of how understanding deepens, beyond what videos alone can provide. So treat this as investigation, not consumption, and share your analysis below.